Good morning, everyone. Thank you so much for joining us today. My name is Tara Kendrick. I'm here with Bill Witt, and we are part of Senior Resource Center. Today's topic in our live SRC University series is maximize your retirement accounts. If you're also ever interested in our book, we have a book, More Money for Retirement, and you can always download it for free on our website, or there's a place to sign up for it to order your book online. You'll get a free copy and you'll just have to pay the $5 in shipping. So it's a great deal. We created SRC University to give an opportunity to teach people kind of how to retire. What things did they come up? What things keep them up at night? We wanted to give these little 30-minute sessions available on your schedule. Whether you listen to them live or you come back and you sign up for our SRC University webinar series, you can always go back and listen to them pre-recorded. We do a lot of topics that are in our book. So of course, our book is always a great guide. And our ultimate goal is to create a safe, secure retirement. And the good news about our school is there is no final exam. And here at Senior Resource Center, we do 4 distinct things. We're very unique in the community. We do comprehensive retirement planning, looking 20 and 30 years ahead, making sure you don't outlive your money. We do tax planning, and that's not tax prep. We just show people how to find ways to pay less tax over their lifetime of retirement. We do a lot of long-term care planning, and that includes federal and state programs. We help people qualify for Medicaid without losing all their money, protecting their assets, and VA aid and attendance. And then last, we do estate planning. We're not attorneys, but we do look over and make sure you have the appropriate legal docs for now when you're alive and then when you pass. So this is part of our summer fall webinar series. We're live every Tuesday at 10:30. And you can see the 4 previous ones we've done. And the one highlighted today is maximizing retirement accounts. That's what we're talking about today. Next week, we'll be talking about Roth IRAs, the golden goose. So be sure to stay tuned for that. And then as promised, we'll have 2 more Medicare presentations because we are coming up on open enrollment, which is October 15th to December 7th. And then kind of throughout the fall, we'll be doing another 6 types of webinars. We've got Pay Less Tax, talking about also long-term care, how to tap your home equity, protecting your wishes, and avoiding probate. And then last, we'll be talking about modern annuities. All right, so as we do at every presentation, we'll just do this little disclaimer. Everyone's situation is unique. The actual results from examples and case studies will vary.
Mom,
We are not security licensed.
I'm listening to a webinar.
We refer all
This
stock
is why I
and
have this on.
questions to
And
the
it's a half an hour
licensed
long, so they may come while it's on, but I'm going to keep it on.
Okay, so let's get started. Bill?
Thanks, Tara. Let's welcome everybody joining us today. And let's start out talking about kind of the challenge that we have as we move into retirement. Most of us will have 2 major assets. Our homes, which have had tremendous appreciation and built up value. And then usually it's pre-tax retirement accounts. If you've worked for an employer, they most likely have a 401k, or you've been contributing to an IRA. And Tara, let's go. Yeah, okay. So our goal here is to maximize the value of retirement accounts. We want to do it in a way that supports a safe, secure retirement. And kind of as a point of perspective, if you look at the markets the last year, they've done phenomenal. They've continued to grow. And it kind of reminds me of the time period in the late 1990s when the stock market could only go up until it didn't. And then 7-8 years later, we had this raging real estate market where people were flipping homes and buying and selling real estate. It could only get better, and then it didn't. And I kind of have that same feeling right now. It's like the market's rushing forward. I just wonder what's around the next turn. So if we look at the history of retirement planning, if we go back to the 1950s, 60s, and 70s, most people retired with a pension. In the early 1980s, the pension kind of fell out of popularity because people were living longer and many of the pension funds were underfunded. And so we saw a transition from pension support in retirement to 401k support, where people build up a bucket of money during their lifetime, their working time, and then draw against it in retirement. When we look at each of these two solutions, they're kind of win-lose. With pensions, if you lived long enough, you outlived what was put in by you and your employer, but your checks kept coming, kind of like Social Security. After about 10 years, you get free money because you've taken all the Social Security you've contributed. But what if you live short? You're living on a pension. Well, then the employer won. They got to keep the money that you had been contributing into the fund. If we go look at 401ks, if you live short, your heirs win. There's money to transition to the next generation. But the big question many people face with a 401k is, will I outlive my money? Will I draw down against it to support my lifestyle and eventually run out of money? And so each of these two solutions to retirement planning had kind of a win-lose proposition. So what are the challenges that retirement accounts face today? And I want to talk about five different categories. First one is government tax policies. We're going to talk about two acts, the Secure Act that was passed during the Trump administration, and then the Build Back Better Act that was passed during the Biden administration, and look at how they're starting to reshape retirement accounts. We'll touch on things also that erode value, management fees that accumulate over time, stock market corrections. We're going to look at long-term care expenses, and then we're going to look at the potential for rising taxes. We know that the current tax tables are scheduled to expire at the end of next year, 2025, and tax rates are supposed to go up. So we'll look at each one of these challenges. Back during the Trump administration, they passed what was called the Secure Act. And there were 6 major elements to this act. The first one was it increased the starting age when you had to start taking required minimum distributions. Under this act, it raised it to 72. Further legislation has now raised it to 73. This was good because many people don't want to take money out of their retirement accounts if they don't need to. It allowed people to contribute to IRAs past age 70 and a half. That was good. 401ks were opened up for part-time employees. That was good news. Small businesses offering 401ks received a tax credit to offset the cost of setting up the 401k. That was good. And finally, the fifth one, annuities were built into 401ks, where now 401ks have to offer an income option, a pension option, as well as just investments. But the last item they did was a major change that really was bad news for 401ks and IRAs. Prior to the Secure Act, if you died and left a 401k or an IRA to your kids, they had the ability to stretch out withdrawals over their lifetime. And because they were younger, their withdrawal rate was much smaller, and it allowed that IRA to become part of their retirement planning. Well, Secure Act eliminated stretch IRAs. Now all funds have to be withdrawn from an IRA or a 401k within a 10-year period. Why is this a problem? Because when you go to heaven, it's very likely your kids are in their peak earning years. And so by being forced to take additional money out of an inherited IRA, it pushes them into a higher tax bracket, and Uncle Sam celebrates. And we see this as kind of the harbinger of what's going on. Our government has over a $30 trillion deficit. It needs more money to operate. And so this eliminative stretch was just the first step in trying to raise more tax dollars, not letting people pass on assets and just let their kids sit on them. Now they've got to take it out, pay taxes. The Biden administration passed an act, Build Back Better, which was designed for a lot of infrastructure construction in the United States. But in the design of this act, the original design, two provisions were built in that were really kind of scary for retirement accounts. The first one was establish value.
Done.
By that, they meant, let's say, set a value, say $1 million of IRA funds. Well, if you have more than that, the owners of those types of policies were going to be forced to take 50% annual distributions of the excess. These provisions didn't get put into law, but I think it's a harbinger of what the people in Washington are thinking about. They're looking for ways to force more money out of these retirement accounts. Because, when we fund an IRA, we get a pre-tax deduction as we're working and we're putting money in. We fund an IRA, we get a deduction. But when you take it out, it's all taxable income. And what was really scary about this was that if this provision had been approved, once it's in there, it's very easy for Congress to say, hey, maximum account value, that IRA of $1 million, hey, let's make it 500,000. In fact, let's make it 200,000 and force out more annual distributions. We think this is kind of the new tax paradigm that's unfolding in Washington as the government looks for ways to get more income. And if you model this, it's kind of like when they put income tax into our system back in the early 1900s, the tax rate was like 5%, 6%, very low. Today it isn't 5 or 6%. Today the maximum tax rate is 37%. So it's kind of like you establish a new model and then the government can tweak on it to its heart's content. So I want to talk about 4 strategies for maximizing retirement accounts. The first is looking for ways to get safe asset growth. Second, we'll look at smarter required minimum distributions. How do we go about taking money out of our IRAs, 401ks, to stretch out the value over our lifetime? Third, we'll talk about protecting our retirement accounts from long-term care expenses. This is critical because long-term care is very expensive. We'll be tapping into some programs in a future webinar talking about ways to tap Medicaid and VA to pay for long-term care. And then finally, gradual Roth conversions, moving from a taxable environment to a tax-free environment. And that's what be included in our topic next week. So let's focus on safe asset growth. And most of us remember the story of the hare and the tortoise. And we kind of use this in our practice. We have a strategy, we call it tortoise investing. And the goal there is to do 2 things: to eliminate management fees and to avoid stock market corrections. Both of these can be very, very painful. So before we talk about our tortoise strategies, what is the market? I think we need to kind of have a general understanding of what we're targeting. There's 2 major indexes that you hear reported every night on the evening news. How did the Dow Jones do? How did the S&P 500 do? Well, the Dow Jones is 30 large companies. The S&P 500 is 500 large companies. And in our world, we think the S&P is a better barometer of the economy. If the S&P is going up, well, the economy is going up because 500 major companies are performing better. So we're going to use that as our foundation. Here's a chart that shows the performance of the S&P 500. I'm showing it with no fees. Can't do that, but for this purpose, I'm showing it with no fees. And it shows over a 20-year run from the year 2000 out to 2020. And as you can see, we had some up years, some down years. It's fluctuating, but it's heading north. So the first thing we want to touch on is fees, which reduce your annual return. And what we found in working with many clients that are in the stock market, some of the fees they're paying are visible, but some of them are hidden. And so let's talk about this. The visible fee is typically what you see in your statement, and their advisors charge anywhere from 0.5% up to 2%. I picked 1% as an average fee that advisors charge for managing your portfolio. But there's a second fee that's not as easy to see. It's a hidden fee. And this fee is based on where your money is positioned. If you're in mutual funds, you're paying an additional fee because the people that run the mutual fund, what is a mutual fund? Collection of stocks, bonds, investments, and it's based on different criteria. It could be the size of the company, could be geographic, could be a specific industry. But if you're in mutual funds, typically what happens is the mutual funds charge a fee, but it's a hidden fee. It's embedded in their profitability. Well, if we add these two together, and boy, my chart doesn't look so pretty today, but 1% plus 1% is 2%. That's not a whole lot. But if you're with your advisor over, say, a 10-year period, paying 2% a year, which is pretty typical, we find that many of our clients have given literally a fifth of their money to these money managers on Wall Street or to financial advisors. So if there's a way to eliminate fees, that can help. So here's that same chart, the S&P 500 over a 20-year period. And this time I've added in a 1% annual fee. Very low, but just to keep it more realistic. The second thing we want to do is avoid stock market corrections, because it's fun when the market goes up, but it's incredibly painful when people see a 40 or 50% correction. These corrections occur every 10 years, 15 years. We don't know what's going to cause them, but they just pop up and they hurt like heck. So I'm going to show you a complex way to avoid market corrections. Then I'm going to show you a product that integrates this into, makes it very simple to do the same thing. The first thing is, let's say we've got $100,000 and we go to the government sells 10-year treasuries. They're paying right at 4% right now. So we give the government $100,000. That bond, we're going to buy a bond from the federal government. It's going to pay $4,000 a year. Now, 4% is a nice rate of return, but I'd kind of like to get a higher rate of return. So what do we do with our $4,000? We know that's going to come in every year. We buy an option on the future market. Now, what's an option? It's an instrument that gives you the right to buy the market in the future, but not the obligation to buy the market. So we can get an option on the S&P 500, and typically with $4,000, I can probably buy an option that has some upside growth. I'm showing 5%. The caps right now are more like 7 or 8%. I'm trying to be conservative. But the beauty of option investing is that you get upside. If the market's up, I cash my option in and I get up to whatever the cap limit is, if that's how the market's grown. But what if the market's dropped in the year? Well, I rip up my option. I don't make any money, but I don't buy the market because I don't want to participate in downside. So here's the two strategies side by side. Remember the hair on the bottom. There's some big years going up, some big years going down. What about the tortoise investing? Well, his upside is always capped at 5%. But in good years, he can earn up to 5%, never more than that. What about the down years? He gets a 0, he pushes sideways. This is an interesting chart because it shows how a safe investing model can work. And we have products that follow this tortoise investing model. You don't have to go and learn how to buy options. There are products that do all of this for you. But there's something else that is important to understand when you look at this pattern of growth over a 20-year period. What didn't we do during this 20-year period? We didn't take any money out. We just let the money ride. But let's say I retired in 2020 and I'm 73. I have to start taking required minimum distributions. I have to take money out. Well, what if I need money to live on? In addition to RMDs, I have to take money out. So let's look at a more realistic chart. In this chart, we added in one more element, and that is I'm assuming I'm taking out $5,000 every year out of my accounts to live on or to satisfy required minimum distributions. And now we see a kind of a tougher picture. In this case, the 100,000 actually went bust in like 2017, whereas the tortoise investing model still had money in the bucket in 2020. So there's three factors affecting your money. One is those management fees. We try to eliminate those. One is market corrections. We want to avoid those. But the third factor is very important. It's when you withdraw funds. If you have to withdraw funds in a down market, you can end up crippling your retirement funds. So people ask us, well, Bill, I don't want to buy a bond and then, buy an option. That's too complex. I want something simple. So they ask me, is there a product that grows when the market grows? It avoids downside market corrections and has no management fees. And the answer is, yeah, they're tax deferred indexed annuities. And we use them in our retirement practice to help people build safe, secure retirement plans. So the second topic is smarter required minimum distributions. And we talked about this a little earlier. So what is an RMD, a required minimum distribution? Well, under current law, when you turn 73, you have to start taking money out of your retirement account, whether you want to or not. You're forced to take it out. They've given you all these years of tax deferral. Now you got to start taking money out. And if there's a chart that the IRS gives out, and next to age 73, there's a divisor. And for age 73, the divisor is 26.5. And if you divide the account value on January 1st, let's say I'm going to turn 73 this year. They take my account balance on January 1st, let's say it's $100,000, and I divide it by that 26.5. It says I have to take approximately 3.8% of my account value out as a required minimum distribution. This is not optional. You have to take the money whether you need it or not. Well, what's the challenge? The divisor decreases annually as we age. So there's a chart in our book that shows age 73, 74, all the way up to age 100. And you see that the divisor keeps getting smaller. Well, when the divisor gets smaller, the RMD percentage, the percentage you've got to take out, increases. And this is something that people often don't think about. So let's take a look at a simple example. Here I've got IRA funds. On the left side, I've got a traditional IRA. On the right side, I've got a traditional IRA. But on the right side, I've divided it into two buckets, two separate buckets. I'm showing it at 50-50. It might be 60-40, might be 70-30. I'll show you a case study later where we divided the money up. And so what I've done on the right side is I've repositioned part of the money, might be 50%, in an IRA annuity. Once again, this is a tax-free exchange, so the money on both sides is still tax-free. When I turn 73, I have to start taking required minimum distributions. So what most people do is they go in, they start annually dipping, taking money out. What about on the right side? Well, the annuity has a feature called an income rider that allows me to turn on a lifetime pension. This is a pension I can't outlive. If you're married, we write it so that it's joint life payout. It pays out no matter who's alive, whether either spouse is alive, you're receiving money. And that lifetime income stream satisfies the RMD amount. If the RMD amount ever goes up to a higher percentage, automatically the lifetime income stream increases to cover it. So let's fast forward. What happens over a period of time? As we get older, the RMD percentage we have to take out increases, and annual dipping is generally causing the IRA value on the left side to drop. Well, I'm also drawing income out of the IRA annuity. And so what's happening there? The value of the IRA annuity is going down. Once again, though, it's lifetime income. If we fast forward even further, something interesting has happened. We've drained the IRA annuity. It's paid out everything you put in. It's paid out everything it earned over a 10, 12, 15-year period. But even when we drain the account, it's lifetime income. Once again, this is just like Social Security. After 10 years, You've received back on Social Security all the money you paid in and what your employer put in. But the checks don't stop. They keep coming. Well, this is the same thing that's true with an IRA annuity. It's generating a lifetime income stream. You can't outlive it. We call this longevity insurance. It's a protection that after they've paid you everything, it keeps coming. But even this isn't the full story, because what do we do when that IRA annuity is nearing empty? We convert it from an IRA to a Roth IRA. And now what are we getting on the right side? We're getting tax-free lifetime income. Think of it like giving yourself a raise 10, 12, 15 years into retirement. We show clients every day how to do this, how to use an annuity to generate lifetime income that satisfies the RMD amount and eventually becomes tax-free. Here's a simple case study. This is a real case. Lucy and Bill, they were both 68. We established a monthly budget for them of $6,000, and we assume that budget, that expense budget, is going to grow 2.5% with inflation annually. We looked at their Social Security. Lucy's going to claim at 68. She's going to get $1,856. Bill's going to wait till age 70, and he'll get $3,564. Both of those income sources are indexed for inflation, so they will go up. Their savings was about $725,000. Most of that, $675, was in Bill's 401k, and we project a 5% growth on that. And then we did some longevity planning. We assume Bill's going to live to 83, and Lucy might well make it to age 100. So this is scenario one. And if you go back a couple of weeks, we spent a whole webinar on the retirement analyzer software we use to show people where they're going to be 10, 15, 20, maybe 30 years into the future. It's kind of nice to know where you're going to end up, to make sure if you're going to run out of money, I'd rather know it now than 15 years from now when I'm no longer able to work and add additional income. We assume Bill's going to pass away at 83. Then we looked at a second scenario. We said, what if we take part of that 401k money, and in this case, we took $275 and put it into a tax-deferred annuity. That annuity will start generating $1,107 monthly income at age 70. And the income has the potential to grow if the stock market is up in the future. So this is kind of a summation of what our retirement planning software can do. It shows a lot of detailed information, but in a summary form, it shows that if we run out to age 100, that under the first scenario, that Lucy still has $345,000 available to her. That's pretty good. But the second scenario, we converted some of that 401k money into an income source. And look what's happened. Now we've increased the financial outcome by almost $241,000. This is the power of income. We did a webinar last week on the power of income. People with more guaranteed income in retirement have better financial outcomes. And we continue to show clients how to do this. So if you're interested in smarter RMDs, give us a call. We can answer your questions. What about protection from long-term care? We've got some webinars coming up that'll deal with long-term care. This is probably the biggest financial risk all of us face. And annuities provide two interesting protections for our qualified funds. First, most of the annuities we write have this income rider feature, which is a lifetime income stream. But they offer something extra. It's called a doubler. If I need to trigger long-term care, often many of the annuities will double the payout for up to 5 years. Now, this isn't long-term care insurance, but it is a way of
Hello.
Hi.
May I speak
Sure.
with Miss Grace?
long-term
This is Sue.
Sorry, Grace, I'm late already.
Yeah, that's okay.
Also, annuities are exempt from
My
Medicaid
name is Wayne.
spend down.
Yeah, and I'm a
You
principal.
want to go over the
Here
table?
we
No,
go.
you can just sit down.
Singing in the background.
Are you comfortable there?
Yeah, but we can,
No,
Yeah.
we can try.
well, wherever you want me to.
There we go.
All right. So the second feature that annuities offer is the ability to exempt the funds from Medicaid spend down. We're going to talk about where some people end up needing long-term care in nursing homes. And unfortunately, nursing homes are very expensive, but annuity funds that hold qualified money, IRA, 401k, Roth, 403b, those are exempt. You actually get to keep all that money and qualify for state-aided Medicaid benefits to help pay for a nursing home. This is really wonderful. Well, let's go back to Bill and Lucy. This is one of the more detailed charts that we show in our retirement analyzer software. In this case, we added in one more variable. We said Bill's going to pass away at 83, but we put in 3 years of long-term care. Now, what is the impact of long-term care? It's big. Today, nursing homes run $7,000 or $8,000 a month. If we fast forward out 8 or 10 or 15 years, we expect the projections are that long-term care in a nursing home will run somewhere between $11,000 and $12,000 a year. This is a substantial impact on Bill and Lucy's finances. Now they don't have money to age 100, but if you go to the bottom now, Lucy hits a red line at age 93. Literally, she's out of money and she's living on $5,600 of monthly income. Well, where does the annuity help out? Remember, we started out generating $1,100, but it increases if the stock market's up. And if we go fast forward, we see that it's reduced dramatically the rate of expenditure. It's cut it down from 11,000 down to 7,000 or 8,000. What is the impact on Lucy and Bill's finances? Well, first, we've given Lucy 2 more years of financial solvency. The big difference is in her go-forward monthly income. Remember, under the previous analysis, she had $5,600 in monthly income. Now we have $9,600. That's $4,000 more monthly for lifestyle. If you were 95 and wanted to pay for lifestyle, I'd like to have an extra $4,000 each month. So earlier we talked about the 2 scenarios, pensions and 401ks. Under pensions, it's a win-lose. You live short, the employer wins. They get to keep your money. If you live long enough, you win. With 401ks, you live short, heirs win, but your future is in doubt. Will there be enough money to see you through retirement? What we add to the pie is what we call a win-win strategy. It's an annuity with an income rider. There, your heirs win if you live short. They inherit whatever's left in the bucket. And if you live long enough, you outlive your bucket, but it's lifetime pension. Well, there you have it. We covered a lot of ground in a very short period of time. I want to thank you for joining us today. If you have questions on maximizing your retirement accounts, please give us a call. We're happy to answer questions, free consultations. And remember, next week, we're going to talk about how to tap into Roth IRAs, which is an extension of retirement accounts. Have a great day.